Tax Care. It's not a name, it's a promise.
So the best solution, if you're looking to make a profit, is to use an S corporation, because that's where it saves you money in taxes. Now, along with S corporations, there's several other things that you can do. You could set up a solo, since you're a individual owner operator, you don't have any other employees. You don't have to do the safe harbor 401k, which is the 401k that you usually see in big companies that offer it to their employees as benefits. You could do a solo 401k. Now, there's a company called mysolo401k.com. You can contact, there's a good gentleman there named Mark. He would actually help you with setting up a solo 401k plan that what it does it, just like how Edward Jones and Fidelity and Vanguard will take your money and invest it, they're called trustees. They're going to take that money, they're going to invest it in certain stocks and mutual funds to see how much money that they can make for you. With My Solo 401k, Mark at My Solo 401k, or one of the guys over there, will set up your account at any account that you want. Patelco, Bank of America, Chase, wherever you bank at, they'll set up, just like how I've set up a corporation for you, they'll set up a Solo 401k trust package. And with that package, you would set up your bank account. So you would have a trust bank account.
What does that mean? A trust
bank
account?
What that basically means, just like how today, after you meet with me, you're probably going to go to the bank if they're open today and set up a corporate bank account.
I actually already took that step.
Oh yeah, we already sent you out some documents for that.
Yeah, I got the articles, so I set up the bank.
Perfect. Well, they're also going to send you out some documents like articles and trust documents.
Okay.
And you're going to use those trust documents, and you're going to go to your bank, and you're going to be the trustee of this 401k, Solo 401k bank account.
Okay.
Why is that important for you to be the trustee? Well, you don't have to worry about Vanguard putting money in the S&P 500, and nowadays the S&P 500 is not doing too well, and they're going to lose your money for you. Well, long run, hopefully you'll make something.
Yeah.
But right now, maybe you don't want to put it into an S&P 500.
Yeah.
Well, with with Vanguard, you wouldn't have that opportunity. You would have to just put it into the mutual funds and
let them do it,
and let them deal with whatever is doing well nowadays. And hopefully they don't lose too much of your money. You can maybe put it into some kind of a fixed CD account, and it'll go up 1% or whatever. But it's not gonna. At the end of the day, maybe you can manage it where you don't lose your principal, if you're lucky. Most people are not that lucky. With My Solo 401k, you are now your own trustee. So what does that mean? You can take that money and invest it anywhere you want. You can put it in the stocks if you want, or you can go and buy a rental property and use all the positive cash flow from that rental property and move it right back into your Solo 401k trust. What happens? Not taxable until you take that distribution. Or you can take this money and put it into a property and flip that property, and all the gains from that property that you flip goes right back into the Solo 401k. Now, when I say property, I don't just mean real estate. It could be cars, it could be vending machines, it can be whatever interests you, whatever type of business that you're getting into, and that you buy and sell for a gain, for a profit. That profit goes right back into this Solo 401k. It doesn't limit you to just stocks.
Awesome. So I mean, if you're making, let's just say if you're flipping a home, for example,
sure,
you're gonna have accrue expenses along the way. So you could take the money out of that account and show that these are the expenses, and then once you gain, you put the gains back in. Like, I mean, what do you do with the losses associated with it? Like,
yeah, so just like a 401k, if there's losses, they're unrealized losses.
Okay.
So if there is a property that you're buying and you're selling, and it ends up being a loss, a loss investment, all of those losses go right back in your 401k. They're unrealized losses.
Okay.
But if there was a gain, all those gains go back in your 401k, and they're not, those gains are not taxable until you start taking distributions from that 401k.
How can you take out money to like take account? Let's just say if you're doing it for a home, you're buying a property, and say you want to fix that property. Can you take money out to fix it?
Yeah, absolutely. So. And
how would you transact it?
So basically, you would write a check from your Solo 401k account, and pay it to escrow to start with to purchase the property. And if there's any improvements along the way, any expenses related to that specific house, and remember, you can't use a house that's for your own personal use. It can't be a owner occupied or a personal residence. It has to be investment property. You can write checks to whoever, to your contractor for purchases or whatever it takes to bring that property back up to a status of for it to be sold, and at that point then those all those expenses are being pulled out of your Solo 401k account.
Okay. So that's my question is, so if there are expenses, you could write checks out directly from that account.
Absolutely, because that's related.
As long as
to
there's
that.
a trail, like document trail that shows that it went to that house, then it's legitimate.
Yeah, exactly.
Okay,
Yeah.
that's great.
Now, why would we want to even set up a 401k? Well, remember that $30,000 example that I gave you on the W-2? This $30,000 now can be reduced, taxable amount could be reduced by the contributions that you're putting into your 401k. Now,
Okay.
each year, you're allowed to put into a 401k. With a solo 401k, it doesn't work like a safe harbor 401k. Right now, with the safe harbor 401k, they're allowing you to put in $18,500, and the employer matches maybe up to 6% or something.
Okay.
With a solo 401k, they allow you to put in up to $55,000. You would be able to put in 18,500 as a normal, how we put in as a maximum amount for a 401k.
Got it.
Same thing, same way it works. It works for the solo 401k. And then you would take 18,500, and the employer matches not 6%, which is usually the max that you see with safe harbor 401ks when you work with big companies that give you benefits, but 25% of what you put in. So that would be 4625. So 18,500 plus 4625, that gives you 23,125 to contribute. This 18,000 would be reduced. You would reduce your $13,000 income by 18,500. So the federal and state taxable amount would only be 11,500, and the rest would be deferred.
So you're dropping even further down
Right.
from that income. Okay.
Right.
Nice.
So, but
How'd you get to the 25%? I didn't get that part.
So you take 25% of your contribution of the 18,500, and you'd get 4625. This right here is the employer's contribution on your behalf. So you deduct this on the corporate level, and you would deduct this on your W-2. So you wouldn't pay taxes on the 18,500, and your K-1 would be reduced by 4625.
Okay.
So your total adjustment to taxable income would be 23,125.
So out of that 100,000 potential taxable, it would go down to like 75 or something like that.
Right.
Okay.